Here's what's coming up on today's show.
So that's why it's important not to panic during those sell-off days, those kind of emotional sell-offs. That's kind of a cardinal rule or a sin, if you will, to sell off into those spikes lower, because if you just kind of take a deep breath and kind of weather it, you will get that bounce and ability to reassess at that time.
This is the Retire Happy podcast with John Amarino, a fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Parsippany, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Amarino, and I am joined by my esteemed co-host and great friend on the East Coast, Mr. Tom O'Connell. Tommy, how are you?
I'm doing great, John. Good to see you again. Always nice to be back together. We had a great interview with Ed Slott just a few weeks ago, and looking forward to the follow-up, talking about the markets and what's going on in the economic world these days.
You know, everyone, we're going to follow up one great meeting of the mind with the most entertaining chief investment officer in all of the financial industry, the chief investment officer of Brookstone Capital Management. He has been a guest a couple times in the past, and we always love his wittiness and his knowledge, because outside of being a great guy, a great human, a funny guy, he is a very, very intelligent man. The chief investment officer of Brookstone Capital Management, Mr. Mark DiOrio.
And introducing the Chief Investment Officer of Brookstone Capital Management, Mark DiOrio.
Well, thanks, John. That was a great intro, and I agree with everything you said.
Yeah, exactly. How you been, Mark?
Great. You know, the markets have been very interesting this year for sure, with the handoff and everything into 2025 after we had a pretty good 2023 and 2024. So it's been a fast-moving market, so we probably have a lot to talk about.
You know, let's just kind of jump right into that. You know, I know you're a big proponent of, you know, every year the market should have some type of correction within it, you know, whether that's, you know, high single digits or even up to 10%. And at the end, as you mentioned, 2023, 2024 were great years. And then we came into 2025 and it was a whipsaw, and we had the volatility, you know, which a lot of people stated were caused by tariffs, but the volatility was also velocity, and by velocity you just had these big market turns. So talk to us about the tariffs and what you think really was the root cause of the big drops early on.
Well, you alluded to it originally when you first started talking about, which is we normally do get a market sell-off or a correction at some point during the year. The average decline of about 10% or more happens about every year. So it doesn't happen every year, but on average, it happens about once every 12 months or so. So that's to be expected. So we came into the year running a little bit hot. So it was pretty normal for the market to have some type of sell-off. And then with some of the uncertainty from the political uncertainty, the tariff uncertainty, that was pretty unusual for the markets to kind of digest. So that just kind of all came together, and yes, the beginning of April, we had very sharp decline days. But sure enough, within about 9 days, the market turned around and has basically sped higher since that time. And I would point out, though, and I think this is important from managing your money and being able to kind of understand the markets, that the best days in the market happen right around the worst days in the market. So it's not unusual if you get, let's say, a 500-point decline in the Dow. In the next couple of weeks, it's pretty usual that you'll see a couple of 500-point up days in the market, meaning the best and worst days are very close together. And even if you go back into the worst pandemic days into early 2020, we had the same kind of phenomenon where March, we had these accelerating down days. And sure enough, you get to April and May, and you have these really good rallies. You know, you don't always feel that great about it, but the market is rallying back and doing it strongly. So that's why it's important not to panic during those sell-off days, those kind of emotional sell-offs. That's kind of a cardinal rule or a sin, if you will, to sell off into those spikes lower, because if you just kind of take a deep breath and kind of weather it, you will get that bounce and ability to reassess at that time.
Do you think that some of those more flash sell-offs or even buys, right, are algorithm driven, big money driven because the algorithm says, hey, a price point is here, we have to sell, or a price point is here, we have to buy? Or do you think that's really a reflection of how the market feels?
I think if you go back long term and look at data, volatility is very consistent in the market over long periods of time. In other words, if you were to go back 50, 60 years, the volatility level is basically the same as it is today, meaning it was a volatile market back then. You go back even prior to that, it was a volatile market at that time. So volatility has actually been consistent over long periods of time. And those single day moves happened at that time as well, big, robust moves up or down. I would say that algorithmic trading is in the marketplace for sure and does drive kind of a lot of daily trading is algorithmic, but it doesn't mean that it makes it outsized necessarily. And from time to time, maybe you do get a little bit extra selling or a little bit extra buying because of those algos, but it's not as big of an issue in terms of the overall market or on returns, your long-term returns as an investor, or your long-term overall risk, as you'd say, or level of volatility that you're assuming in the portfolio.
So do you think that early year volatility was more due to the transition, say, of politicians as opposed to something being wrong with the market, or combination, or what's your feeling on that?
So I think we were overbought and we're just kind of due for some type of correction. So you'd add part of that as the decline. That's how it basically started. And that's pretty normal for a market to do that, being overbought as it ran up, now kind of having a little bit of a sell-off or a pullback as that pauses. And then you had that big uncertainty factor. And that, I think, put a lot of people to take a step back and just not be as aggressive buying. So that allowed the sellers to come in and maybe be more aggressive on the sale side. So yeah, there was definitely trepidation. And we looked at the data. You can clearly see a spike in kind of political, economic uncertainty around the tariffs.
So with the tariffs, do you think now any tariff news going forward, because we're still getting, as of recently, we had the Canadian tariffs. Do you think the tariff news in the future is more the market's bought in at a price adjustment, or do you think it's going to be sticker shock like it was potentially in the beginning of the year?
Well, I think there was the idea that what are tariffs going to do? Is it going to cause this inflation get out of control and rates are going to have to go higher so stay steady? And none of that came to pass. Our view was that we're not policymakers, we're investors. And the tariffs are a tool. In other words, it's not going away. That is a policy tool or a negotiating tool that's going to be used by the administration, and that can adjust as it had. And I think the market started to come around to that view that it's not as kind of a doomsday event or necessarily an inflationary event. It is a negotiating tool or tactic used by the administration to enforce their policies. And I think that's important where, sometimes you get asked in this business, well, what's the right thing to do? And that's not really our role. Our role is really to observe the objective data that comes in and then make good decisions in the face of uncertainty. And so we just reviewed the data and kind of let the data take us where we think it should go. And so again, there's been no real inflation impact from the tariffs, which was the concern before. And then as that concern gets alleviated, that allows and provides support to the market and has provided support to the market rally, which has really rallied since April, and we're into August without much of a pullback at all.
Do you see a period of inflation coming? I mean, we're into August. Supposedly, the July report is saying that inflation was higher than expected. Job creation wasn't as well as predicted. So is this kind of a summer blip, or what's your thinking on that?
Yeah, you mentioned the two main points here, which is it's inflation and employment. So if employment is weakening a little bit, although you're still at full employment, under 5% would be considered full employment. Under 5% unemployment rate is considered full employment. There's always a certain percent. And then you have inflation in that 2 to 3% range. So it's still in a very comfortable zone. So whether it's 2.8 or 2.7 or 2.9 or 2.6, that'll all change every month. You'll have a little bit of a wiggle in there. So I don't think that's too concerning overall. So if you're in that zone, you're actually in a pretty good place. And if you have unemployment under 5%, you're in a pretty good place as well. I think the surprise has been how resilient the economy has been, how resilient businesses have been, how resilient the consumer has been, and some of the themes that have come out really with the fruition of AI intelligence and some of the spending that companies are doing, and that's going to affect the entire economy. So I think the market's looking past some of those little nuances at what's really going on thematically in the overall economy and markets.
Now, typically your strong months are March, April, and then, they typically have gone, sell in May, stay away, and it's kind of like the summer's off. We've seen that as a complete upside down this year. Now we're back at the market highs, which, for a lot of people that Tommy and I have preached, that's actually a point of maximum financial risk. And you have to be careful about buying into the market at the top. With the markets being resilient and, we've seen a lot of long-term bullish signals. We also know, and again, going back and into the 10% pullback, September is often a month where we've seen that. I think historically, what is it? Mark, correct me if I'm wrong, 52% of Septembers have been negative months historically.
Mm-hmm.
Do you think that we are going to see a retracement in the near future? And kind of playing to Tommy's point on interest rates, do you think a drop in interest rates could actually, if you do believe a retracement, do you think the drop in interest rates could countermand that?
Yeah, I think we'll get, I'm not sure if we'll get the full 10%, maybe, and that's considered a market correction. If you have a drop of 10% or more, anything less than 10% would be considered a market pullback. And then a decline of more than 20% is considered a bear market. So those are just rules of thumb, but how we talk about it. I do see some pausing or sideways action at this point, and that would be consistent with the seasonals that you're referring to in September and October. Just some uncertainty there. That's pretty normal. Sometimes you get big sell-offs. I don't know if we'll get a big sell-off this time unless there's something that comes in and disrupts the markets. And by that, it's somewhat unknowable. But if you have the economy pretty strong, a rally like we've seen off that bottom, because you had the sell-off earlier in the year, and now you may just have a consolidation phase where maybe a couple of days look like it's selling off, something bad, bad news happens or a bad earnings report happens, but it may end up just kind of churning, moving sideways until there's clarity on the rate picture, which is, as you mentioned, the Federal Reserve is expected to lower interest rates in September. So the expectation by the market is that they'll lower in September by 0.25%, and then they'll lower again in December by 0.25%. We'll know more into September, but that is the market expectation. And usually when they reduce rates, it's very supportive of investment assets overall. So they could disappoint. That would have the market sell down maybe a little bit more than maybe just a sideways consolidation. So right now, our expectation is that they are going to cut 0.25%. Rates are at 4.25% to 4.5%. That's the Fed funds rate. So what the Fed does, the Federal Reserve, they control monetary policy and they set short-term interest rates. And what their goal, and that's technically it's the overnight rate that banks lend to each other at. And then when they set that, it tells you, it informs the market of where overnight rates are going to be at, and they enforce it. And they have a dual mandate, which is one, to promote policies that encourage full employment. So that's an unemployment rate at 5% or lower. That's kind of a rule of thumb. And also pursue policies that maintain stable prices, and rule of thumb that's inflation in the 2 to 3% range. So both of those objectives are being hit. If you were to look at what's called a Taylor rule or something kind of very nerdy in finance, what should that rate be? That means, okay, if you don't really have inflation, you don't have an unemployment problem, then what is the neutral rate? It would be at about 3.25% today. So rates do have room to come down. And what the Fed is doing, if you have an inflation spike, they would raise interest rates to slow down the economy. So that's what they did in 2022. And that would be pretty negative for asset prices. If unemployment is heading higher, then they'd lower interest rates to try to get that employment back online and to encourage that. And that's what they did in 2020 when there was a lot of uncertainty around the pandemic.
So that 3.5% rate, that seems to me to be lower than historically what we're used to. And maybe that lower number has come about since, I guess, 2000, 2008 market corrections and things like that. But if we go back a lot farther in history, wouldn't you say that the average or standard rate is more in line with where we are today, or am I?
The long run is more in line. So yeah, if you think about it from kind of the trajectory from the 80s into the 90s, it was coming down from an elevated level into the 70s, into the early 80s. But for many years, it took a long time to get down as rates continued to be lower. And probably what most people think of is maybe their mortgage rate as the easiest point to look at. Well, what was your mortgage in the early 80s for those that go back there, or even in the mid 90s or late 90s, it was higher. And then into the 2000s, they started to lower rates because you had at that time kind of the end of the tech boom, the original internet tech boom into 2000. And then the housing market stayed pretty buoyant up until that 2006 to 2008, where they had raised interest rates. And then that ultimately kind of led to the housing market kind of being exposed at that point. We're not in any of those environments, whether it's the internet mania or the global financial crisis event. This time is different. A lot of people think back to those two periods as bad case scenarios just because you remember them, but we're not in that type of environment. For example, although prices are very elevated, home equity is very high, a lot different than it was in that 2007 area where we're clearly over leveraged in the housing market, and banks were over leveraged. There's been changes to the rules where banks aren't nearly as leveraged as they were at that time, especially the big banks, where they have to have a lot lower loan to values, as it's called, than they could at that time.
So you think this lower number is the one that we're going to be getting used to going forward?
Yeah, and I'd say it's higher than what you've seen, as you're pointing out, from basically in the 2010s.
Right. So
that zero interest rate world at 0 to 2%. We've left that world now, but it's not going to be a ratchet up to the 7, 8s and overnight money or higher. I think 3.5%. In that range is probably more realistic, 3 to 5%, something like that. Maybe occasionally they go down to 2, but it's not. So we've left the zero interest rate world, but now we're just one step above that in that 3 to 5% range.
Yeah, I don't see how they could let it get to that 7 or 8% range again. But I mean, the government just couldn't afford to pay the interest on the debt.
It's a good point because you may start to hear something called yield curve control, where they really try to make sure rates are stable across all tranches or maturities, because they don't want the rates to get out of control because of the debt. So it's a good point.
See, John, I can do that every once in a while.
You do, Tommy. You do. That's why I chose to do this podcast, because you're just a wealth of knowledge, my friend.
I thought it was for my ability to recall ancient history.
Well, that is true. I mean, when I want to go back to the first years of the market, I have you here for personal experience.
Right.
So talking about interest rates and lowering, and volatility this year. Obviously, especially when you're dealing with retirement portfolios, there's always got to be a focus more on safety first, right? You're not, you know, for a lot of people, you don't have the ability to reduce some of your or lessen the blow of losses in your that you had during an employment when you were making contributions to your 401k. Now you may be making the issue worse by taking distributions. So in diversified portfolios, we use bonds as a diversification and defensive position. And, you know, a lot of people don't really understand the bond market. I could even argue a lot of advisors don't understand the bond market and they don't understand how big the bond market is. So a lot of questions I get, and I would like to for you to address this, is people see a 3-month government T-bill or whatnot, and they say, whoa, 4.5% 3-month. That means I'm going to make 4.5% over 3 months. Can you talk about the yield? And then even within that, we see negative, you know, you'll see a short-term bond have a negative 0.1%, where they say, well, this is supposed to be defensive. If this is negative, how am I going to get 4.5% at the end of this time period?
Sure. So if you see a 3-month and they quote 4.5%, obviously that's the annualized rate. So you'd make 1% and change over that time. If it's a 3-year bond and it's at 4%, well, in the market, every day yields move a little bit. And there are certain periods of time where they can move, you know, 0.5% when, for example, the Fed is reducing or increasing interest rates, or the market makes an adjustment based on economic data that comes in and it surprises the market. And so rates adjust to adapt to current market conditions. If interest rates rise, bond prices decline. So you can absolutely show a loss in a bond portfolio. So in 2022, bonds across the board were down about 10% because rates broadly rose. So that's pretty big decline in what you think of as a conservative investment. So where it was at, and we can use our 80s and 90s and thought process of, oh, bonds were pretty stable. That's because interest rates continued to decline. So prices really didn't decline. You didn't see that. And rates were higher in that maybe 6 to 8% and a little bit higher on those traditional bonds. Today, in that 3 to 5% range, boy, you can really see a difference when the prices move around because the interest just isn't enough necessarily to offset that from quarter to quarter at different intervals. So that's what happens. If you hold on, you'll get your yield to maturity, and that'd be an annualized yield to that time. But certainly in period, you can see fluctuations for sure.
To your point, that 25 or 50 basis point movement in a 3.5 or 4% interest rate environment has far more effect in either direction than if you're in an 8 or a 9%, rate atmosphere. Mm-hmm. So of course it's going to have a more dramatic effect.
Yeah, and I would say something else on bonds. So when we put together portfolios, as particularly in this environment, we are very mindful of not going overly conservative. As you say, we are concerned about the sequence of returns risks, and that's why you build a good diversified portfolio and have some defensive components in there. But keep in mind that there's 2 components that you're battling over time when you're planning: inflation and volatility. So volatility is the short-term risk, how much the portfolio is moving up and down. And then inflation is the long-term risk. So if inflation's in that 2 to 3% range, that would be eating away at any of the interest on the bonds. So you have to think about that as well. And what we've just seen over the last few years is, boy, inflation you can really see a rise in prices that takes you by surprise. And usually those prices don't roll back as nicely as you'd like them to. So part of being an investor is saying we're putting together an investment portfolio to, one, preserve our purchasing power over time. So that's keep up with inflation over time and grow that purchasing power over time. So that's a key component when you build that portfolio. You want elements of both, then you adjust it for different client appropriateness or risk profiles.
Now, you mentioned volatility and the measurement. So there is an index that measures volatility. It's called the VIX. And in your latest newsletter, you were talking about that the VIX fell below 15, signaling investor confidence but hinting at potential complacency. And when I've looked at charts on the VIX this year, we've seen the VIX go up to 20 and back down to 15 within a week. So, can you explain the VIX just a little bit? And then what is that number that if someone were to look at the VIX that they should be concerned about, and how long that number should stick? Like if it goes up to 20 but comes back down, that's not such a big deal. But if it sticks at 20 for more than a certain period of time, should that be worrisome?
So the VIX is considered the fear gauge or fear index in the marketplace. And basically that spikes higher during moments when the market is selling off. It's really a measure of uncertainty. Mathematically, it's used in the calculation of certain derivative instruments, but you don't need to know that. What you need to know is really it goes higher when the fear in the marketplace moves higher, fear and uncertainty. So we call it the fear index. And the way we use it is the number that you might be looking for, and it's really more of an opportunity, is a VIX number above 30. So the average is between 16 and 18. If you see, that's the long run average. If you see a number above 30, that's actually a pretty good sign that there's a lot of fear in the marketplace. And that's a time where you can start to think about maybe being a little more aggressive or that there's opportunity here. So I wouldn't necessarily sell into those spikes in the VIX. They actually turn out to be good entry points. Now, it doesn't mean it's the bottom, but it means you're starting to form a bottoming process. And so maybe it goes lower as the fear kind of just runs its course. But then the ensuing rebound usually takes you well through that level that it initially had. So we look at it from kind of that lens, saying what's the opportunity. And usually these are just spikes and they're short-term spikes, and then they roll back under 20. The other concern would be if you had a very low VIX, which if you grind towards 12, and we have seen that, now we're in that 15 range. If you're below 12, and definitely if you're below 10, that would show too much complacency in the market, and we are overdue for the market being surprised and caught off sides. And then you'll see kind of the market could take a hit from that point.
So do you see movement like that more out of outside influences? Is it because of bad corporate earning quarter, announcements, combination, black swans? I guess what I'm asking is, when are we more likely to see a spike up or downwards in that VIX?
Yeah, largely it's exogenous events, unexpected events. Black swans are good examples, even gray swans, if you will, to use that term. Really unexpected events that kind of take the market that wasn't prepared for this risk or what have you, that come in, shake the market a little bit. And a lot of times these are short-term risks. Sometimes at the end of maybe a long decline, a slow decline, you get the final kind of climax selling, they would call it, where, okay, finally the last of the holdovers sold. So that could happen just from a market's perspective. But it's not necessarily because of a bad earnings report, because another company will have a good earnings report, and those start to balance each other out. One day, maybe, one of the companies had a bad report, and then the next day, a company had a good report, and a different part of the economy is doing well. And so as the economy is diverse as the US is, you can have these rolling events where certain areas aren't doing well, but some areas are doing well. Okay, we've actually had that economy quite a bit, where the tech sector and certain companies in AI and have been doing really well, and then other more consumer defensive type companies have been doing a little poorly. So you can definitely have that environment. That's one of the unique aspects of the US and the US market, which is we're far more kind of dynamic than most of these other country indexes or big companies. They just don't have the broad cross section of companies.
So talking about defensive, we talked about bonds. Let's kind of change gears into other alternative investments out there. Obviously, with the dollar issues, gold, silver, I've seen platinum really have a good year. Bitcoin, Ethereum, and also, can you talk a little bit about the Brookstone favorite, the structured note? as just alternate ideas. It's not always about the S&P 500. There's other things out there that can be very profitable even when the markets are down.
Yeah, for sure. And I think gold is a great example of that, which is gold can diversify bonds and stocks. So it's actually a pretty unique asset. It moves on its own beat, and it has been having a good run. And a lot of that has to do is if the US dollar is weak, gold is usually strong. They're inversely related. So part of this, I think part of the policy is not to have the dollar depreciate dramatically, but the dollar came into this year overvalued on a purchasing power parity basis relative to just about every currency. And so it's natural for the dollar to depreciate relative to those currencies. It ebbs and flows up and down. It's a free floating currency. Gold is a beneficiary thereof. And so I think what we've seen just in the global marketplace and as some trading relationships have changed, and they've been changing for 6 years, you'd see gold as a neutral reserve asset that is recognized globally. Then you don't have to use, let's say, just the US dollar as you had for many years. And part of this has to do from the US perspective with the changing dynamic in the oil markets, which we're now the largest producer. So Saudi Arabia and Russia used to be, if we go back 15 years, but today we produce more oil than both Saudi Arabia and Russia combined. So it is less of a concern for the U.S., for example, if two countries trade oil and they're not settling it in the dollar. It's just not as big a geopolitical risk anymore. So we've seen gold take a bigger stage and be a beneficiary thereof. So that's a pretty good component that you can add to your portfolio. There's no earnings per se that you have to worry about. Earnings are down. There's not consumer spending that you have to worry about. Gold's gold. It's a kind of a global asset, universal type of asset. So that's been nice to add to portfolios. And a few of those, whether it's silver, a little bit different, but and platinum, same kind of idea. Bitcoin, Ethereum. Bitcoin's a little bit different than Ethereum, but I think they get lumped together sometimes as cryptocurrencies. But that has come on the scene the last year, really, I would say, with the advent of the ETFs, which give you access to those if you're familiar with them or like to add them to the portfolio. And then the other one, the big one that we talk about a lot here is something called structured notes, which is a hybrid investment vehicle. And what we like is the income generating ability combined with the level of protection that it provides. So our classic flash note, as we call it, we're a large enough buyer where we negotiate notes that are issued by the major banks on Wall Street. So what they'll do is they'll issue a 1-year note, and they'll give us the payment terms. So that's the coupon rate. And those coupons typically, it'll vary, but let's say between 8 and 12%. So above kind of current rates that you're thinking, but it's a little bit different than a bond. The underlying principal is protected up to a 30% decline in any one of three major indexes, the S&P, the NASDAQ, the Russell, so common indexes, but you have a 30% barrier there where if the index over the next year does not decline 30%, you get your principal and all the interest back. So it's a pretty good kind of combination of income and principal protection there. And then what we do is wrap that into a strategy where we ladder those notes over time. And again, it's not the whole portfolio, but it is a component to the portfolio that helps diversify traditional stocks and bonds and other asset classes.
So I want to go back just real briefly about a comment you made about the trading of oil in the open market there, just because there was a lot of noise and a lot of news up until July about the whole BRICS thing, right? Mm-hmm. Where they're going to create their own currency. I think their major asset is the oil. And it just sounded like the whole thing fell apart in July and that, it's all the hype was kind of for nothing. Can you maybe just touch on that a little bit?
Yeah, we were never big believers in that. Part of the reason was because they don't trust each other. So we thought it was going to be a little bit hard for them to kind of come to terms with something as complex as kind of a monetary union, if you will, where a neutral asset would make more sense. So gold, for example. being where you settle those payments at. So I think with the changing of these relationships, I think that's normal. So Russia and China are going to trade a little bit together. Do they need the US dollar? Not necessarily in today's world. And so where at one time that was a big geopolitical risk, today the risk is really, and what drives geopolitics is not oil, it's semiconductors. So semiconductors process and store data. And if you remember, and a great example, I think, is if you remember in the pandemic when you'd see the picture or the video of all the cars in the lot, and they said they couldn't get a move, all the new cars couldn't move because they were waiting for semiconductors. Well, they weren't waiting for oil. They were waiting for semiconductors. That's how critical and important semiconductors have become. And so oil, as we're the largest producer now, has kind of taken a back seat to semiconductors, which is powering the modern economy, where it's in your, obviously all our cell phones, all our computers, even our coffee maker has semiconductors, cars, it's kind of all over. So anything powering the modern economy has semiconductors related to it. And again, those are those little chips that process and store data. And so all the bells and whistles in your new car, that's because they have a ton of semiconductors in them, making that available. So Taiwan is the biggest location for actually making the semiconductors, has the largest foundries or factories. The U.S. is, and that's why China and the U.S. talk about Taiwan a lot, and why that has become kind of a tense area from time to time. And the U.S. is making headway in trying to build semiconductors here in the U.S. And we really kicked that off in 2022 with the CHIPS Act, but that's the spending is going to be much more than what the CHIPS Act had, which was about $50 billion. It's going to be at least 10 times more than that to build out our manufacturing capability, because it's highly, highly complex manufacturing. And it'll take 10 years basically to get up to speed with labor up to speed and sophisticated manufacturing and so forth. So it's exciting. It'll just take a little bit of time.
It does seem like a long way off when you say 10 years, but I guess at the end, that technology, it does take a while, right? But 10 years seems like a long time. I know we talked about this when you came to do the dinner in New Jersey, and one of the questions was, and I'll re-ask it, what's your thought process on China actually doing something about Taiwan? Why would they or why wouldn't they? And what you think that the market reaction to that would be?
Well, they would do it because they want to have access to the most advanced chips. So you may see some policies, and all the administrations generally have kind of curtailed exporting our most advanced chips to China. And so that's still kind of the case today, where we want the most advanced chips, whether it's in military equipment, but also for our technology broadly in the country. So they would do it to get access of that capability in Taiwan. They wouldn't do it because they don't want to they need the chips just as bad. And they don't want to, they're not going to come in and try to burn it to the ground, for example, because they want the foundry and they want the skill set as well. So it's kind of a delicate balance. You're talking about high-end engineering, high-end manufacturing. And if the people that know how to do that kind of vacate, or you can't get a hold of them because they left the country, well, now they're back where they were and just have the land, for example. So it is a delicate balance, I think, and a geopolitical and kind of a strategic initiative of a lot of countries. So a lot of countries are trying to get up to speed on that manufacturing capability. So I think it'll be that balance between the two, that standoff as facilities on both sides kind of build up and grow.
All right. Well, we've gone a while here, so it wouldn't be a podcast without, I guess you should actually do this part, Tommy, because we're going to refer to Johnny Carson with Mark putting on his Karnak hat. Mark, where do you see the markets going in the next 6 to 12 months?
It's interesting. Even though we've had a lot of momentum and the market seems to be at high valuation levels, historically, when you get a run like we've had over the last few months off a bottom like that, it tends to continue for the next year. That momentum continues. And as if you have the economy inflation and unemployment at pretty stable levels and interest rates are coming down, coming lower, that continues that support for the market. So I would say higher, and S&P maybe 6,400-ish around time that we're recording this. I would look for maybe a 7,200 target. So there's more left.
Impressive.
Nice.
It is. I would tell you, I'm sympathetic to those that talk about higher valuation, but there's a lot of spending AI. It's that's going through the entire economy, and that's not short term. That's CapEx, and that's going to be in the $1 trillion range. So, barring obvious exogenous event, that's what we'd say. That's what I'd say.
And
I'd ask you for John about the Iraqi dinar and the Vietnamese dong, but I think we'll save that question for another day.
You always got to have the speculative stuff, the lottery tickets, Tommy. What about, you mentioned AI, QQQ, NASDAQ. Do you see that outpacing the S&P 500 going forward?
Well, I think this is that's probably a difficult question. I'll tell you why, because the top stocks, the top tech stocks or tech related stocks have really driven this rebound for sure. And it's different than in the late 90s. These companies have very strong earnings, very large, very powerful networks, and a lot of cash to spend and invest. And you see them doing that. However, they have left the other 490 companies kind of undervalued relative to average valuations. So I'm more confident in the overall, let's say, upward trend, just because I'm not sure which one will lead. But I would guess that maybe tech continues to have a little bit of a halo around it with the spending, and maybe you just get some comeback with the other 490 that keep pace with the uptrend.
Do you think that we're still going to see somewhat strong dividend earnings from companies, or are they eating tariff costs for the consumer now, and we see some changes in either their valuations or their quarterly returns or their dividends?
I think you're going to see companies that have kind of lagged behind spending and updating their businesses to the modern economy. Like, you can see the big difference between the valuation of Amazon and Macy's, for example, and Kohl's and some of these other companies.
Macy's is still around? Oh, sorry.
But it's stunning when you look at it, meaning that company, if you because we've seen even with the Walgreens having trouble and all these, they just
Rite Aid
haven't
going under.
Yeah, it's they just haven't competed, and they're going to have to compete at a little more aggressive pace. And so I think that's another capital expenditure, and AI might help them do that, meaning they're putting money in there to update their systems, something that they most likely lagged behind, thinking the internet was just a fad.
Well, Mark, we appreciate your time. We appreciate the ending part where the wave of the market growth may just be beginning. There's a lot of market growth potentially in front of us. And, as always, we just love you coming on, giving us your expert insights and really explaining it in a way that's easy and relatable to our viewers. So thank you.
Thanks very much.
Well, definitely an honor to be here, Tom.
Of course it is.
Yeah. Any time with Tom is a good time.
That's true.
So, Mark, we will see you next month in Dallas at the Inspire.
Looking forward to it, for sure.
And folks, that wraps up another episode of the Retire Hat Podcast. We appreciate you listening. And as always, if you have any suggestions for what you want to hear, visit the retirehappypodcast.com, leave us a message, and we will make sure to get your podcast topic on our future shows. Until next time, folks, take care and retire happy.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-758-9889. That's 858-758-9889. Or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623. And online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description of today's show for all that contact information. Don't forget to subscribe and follow the podcast on your favorite apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Amarino, Thomas O'Connell, and guests on this show are their own, and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk, and unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives, and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone, and hypothetical example is for illustrative purposes only.